everyone, Bob Schumann here. Welcome to part 4 in our series of videos on how to use the ideas of Einstein, quantum finance, to build a perfect portfolio. Here we are. Let's go. So it's important to remember that since Einstein's general theory of relativity, we now have two types of time. The first one I call, and I think most people call, psychological time or monetary time. It's called psychological time because it's connected to our emotions. There you see on the left, you see the emotions that correspond to the picture on the right, the monetary cycle, the short-term and long-term, the short-term debt cycle overlaid on top of the long-term debt cycle. Another way of looking at this is from the velocity of money. As the government prints money, Milton Friedman used to call it, as the helicopter drops off money, people feel richer, they get greedy. It's not greedy, but it's excitement. The animal spirits, the great British economist Keynes called it. And there's more trading that takes place. There's a lot of business, and the gross domestic product grows as the money supply increases. But I want to give you a clue already. Think about it. While the economy may speed up and slow down and expand, but does it ever disappear totally? Of course not. That's a clue that this may be sort of a mirage, or what we call patternicity. You think back, before we invented calendars and the hourglass, and now electric clocks, mechanical clocks to measure time, what was there? There was just light and darkness, evening and night, day and night, and the 4 seasons. Our ancestors had no idea how to anticipate when was the time to plant, when was the time to harvest. It's one of the reasons we invented clocks and even mathematics. We often forget that time and money are just mental constructs. They're just ideas. They're not reality. With his theory of general relativity, Einstein proposed that a much better model that's closer to reality is that time is the 4th dimension of space. That time is relative to how fast we're moving, or at least the person who's measuring it. That if you live, the farther you move away from the Earth, the time slows down. And that the faster you move, time slows down. The closer you get to the speed of light, when you get to the edge of a black hole, time even stops. Think of that, time stops. We forget that time and money are just ideas, mental constructs. They're models. And some models of reality are better than others. Newton's theory of time and the laws of motion are one of the greatest inventions of man. So I'm not saying they're bad. I'm just saying they're very accurate up until the closer we get to the speed of light. But what about finance? When is a good time to invest in stocks? You know, right now, people are saying the market's at an all-time high. Compared to what? Just to what it was in a previous time. Why does the market always go up over the long haul? Because it always expects a positive return. The market wouldn't exist if it didn't expect a positive return. There's always buyers for people who want to sell. The market never goes down to zero. In fact, the market is an economic indicator. It tells us, most people read it as saying it's telling us what's really happening in terms of going into a recession or a growth period. The proof is in the pudding. Here you can see the results of the outdated model of time, market timing. I want you to focus on that turquoise blue. These are mutual funds, the record of the entire industry in 15 types of stock equity market funds. You know, the large cap value, micro cap, small cap value. So those are just, you can't read the print, it's real small, but different types of stock market mutual funds. You can see in the industry, the turquoise blue, those are the funds that no longer exist. The academics call it the industry's dirty little secret, survivorship bias. If there's a bad fund, they just close it and move the money into a new fund with a new name, and it starts with a new record. Here's another look. The power of now and always versus market timing. On the top, I don't know if you can see the numbers. Can you see what the survival rate is for dimensional funds? After 1 year, it's 100%, 3 years, 100%. All their funds survive. Only in the 10-year mark, they had one fund they closed because it was for a private party. Otherwise, they've never closed a fund. After 20 years, 100% survival rate. And you can see the outperformance is 79, 86, 90, 86, 60, 74, 85, always in the top. That's science. If you look at the industry, just one company based on continuous time finance, one company compared to the industry, where at the end of 20 years, 44% of the funds survived and only 17% outperformed. I want to acknowledge Robert C. Merton, who is called by his peers the Isaac Newton and Albert Einstein of financial economics. You can see his book there, Continuous Time Finance. He also is the man who took the CAPM, the capital asset pricing model, which was a snapshot, and took the concept of continuous time finance and expanded to the model, which is what everyone pretty much accepts today, the intertemporal capital asset pricing model, the 1997 Nobel laureate. So we just finished phase 2, part 1. We want to invest in continuous time. So we're taking only the risks that reward to capture real returns.